basically forced every central bank in the world that holds dollar reserves to have to come up with a plan B. Ultimately, is going to put an undue amount of strain on the dollar. And so one has to understand what's happening and pay attention and try and identify the points where that pressure on the dollar starts to increase, because that's when things get interesting. The rule of law in the West is not what it is, what it was. The rule of law is being changed. Contracts are being ripped up. There are all kinds of examples of that. It's a big step for investors to take, and it means a lot of thinking, and it means potentially some big adjustments to your portfolio.
G'day, Shay Russell here from Rock Solid Investing. And boy, oh boy, oh boy, I hope you have hit like and subscribe so you were notified the minute this interview dropped. Today, I am very privileged to be joined by the incredible Grant Williams, who probably doesn't need much of an introduction. Although he has been in the financial markets for about 35 years, he is highly sought after for his unique take on the market and the in-depth analysis he provides. Now, Grant Williams started out writing his newsletter, Things That Make You Go, back in 2009, and it is one of the most widely read financial publications today. Now, today, Grant talks about how global reserve currencies have been transitioning since the 15th century. There's always been one that's dominant. So the US dollar's dominance, looking at coming to an end, isn't actually out of step with history. However, what we are seeing is not so much the death of the dollar, but more that other countries are looking to find ways to trade and avoid the US dollar currency. Grant delves into that. A couple of other things we cover today is how the Fed were quick to step in and rescue banks and what this actually means for the laws of the markets that we're constantly applying. We look at gold and why you should hold it. And according to Grant, he says, don't put a price on gold, but look at what those ounces could get you in exchange for something you might value. And finally, he has one tip to help investors get started. Of course, make sure you stick around to the end so we can talk about what we've learned together. Grant, how are you?
Shay, I'm good. My tail is firmly between my legs for keeping you waiting. I am so sorry. You've been so patient with me. Everybody should know how patient and wonderful you've been. So my apologies for being late, and I'm delighted to have a chance to chat with you again. It's been a while.
It has been a while, and I absolutely was not going to bring that up, Grant. I was going to let that slide completely.
I know you wouldn't. That's why I want to make sure that everybody knows what a kind soul you are.
Thank you. Now, once again, you and I find ourselves on the same continent, which is extremely rare. You're currently in Sydney, Australia, and I'm based in Melbourne, Australia. However, I believe we're going to have a US-centric chat today, which is rather odd given your origin and my origin. Now, I sort of want to kick off because I've noticed on a lot of your feeds lately, and I can't help but shake the fact that this is becoming an increasingly prominent conversation, and this is about de-dollarization. Now,
yes.
I'm not interested in conspiracy theories, and this is why I've come to you on the matter. Currencies are global reserve currencies have varied over the past 600 years. Since the 15th century, there's been a change in dominance of what is essentially the world's reserve currency. So the concept of moving away from the US dollar after a near 100-year reign isn't completely foreign. However, what I want to do is talk about why the implications with the reserve moving away from the US dollar are probably greater this time compared to other currency transitions that we have made in the past.
Yeah, look, for sure. It is a fascinating subject. It's one that's very difficult to steer clear of. And look, everybody's got an opinion on this. And the thing that kind of frustrates me about it is everybody is so dogmatic about it. And what you tend to get are two camps. One that says this is going to happen. The dollar's dead. It's finished. It's gone. It's just a matter of time now. And the other camp is it'll never happen. And like everything, I think the truth is in the middle somewhere. You mentioned talk about previous transitions from other reserve currencies. The pound probably before the US dollar. Going back to the Spanish peseta and the Portuguese escudo, believe it or not, both of which have completely vanished and been kind of subsumed by the euro. It happens. It's a fact of life. And what generally tends to happen is the country that has the reserve currency overextends itself, and ultimately the debts and the deficits cripple it, and it makes the currency unviable. The difference we have this time is the sheer amount of debt that's been built up over the years. And if you go back to the most recent kind of toppling of a reserve currency, which was sterling. After the war, obviously Bretton Woods came in. After World War II, Bretton Woods came in, and that was really the start of the dollar standard. But it wasn't until 1956 and the Suez Crisis when Britain was really dethroned, and that was really done by the Americans. That Britain needed loans from the Americans in order to finance an incursion into Egypt when they nationalized the Panama Canal, the Suez Canal, sorry. And the Americans played hardball and basically had the Brits over a barrel, held them there, went to the United Nations, got a vote against them, and that was it. Britain was finished. The point being, there was a superpower actively working against the Brits to bring an end to that regime. And that's where we are today. We have the Chinese and the Russians actively working to bypass the US dollar. And if you look at the reasons they're trying to do that, they're absolutely valid, right? The US has a stranglehold on the global financial system through the dollar being the reserve currency and through the fact that every dollar trade has to go through the SWIFT system. And they've used that stranglehold as an offensive weapon a number of times in the last couple of decades, by excluding countries from SWIFT, which creates a massive problem for them because it stops them trading in dollars. And as many people watching this will know, and some may not, but it's definitely an important thing to understand, is that oil for the last 50, 60 years has been traded exclusively, for all intents and purposes, in dollars. And that's where the underpinnings of the strength of the US dollar comes from. Now we see a whole bunch of countries actively trying to find ways to transact oil in countries other than the US dollar. And yes, it's happening at the margin. And yes, it's not happening in huge size, but the yuan, the ruble, the rupee, the Turkish lira are all kind of countries being thrown in the mix, currencies being thrown in the mix to try and find ways that countries can trade in their native currency rather than have to go through the dollar. And the reason this has picked up, I think, picked up the pace is important to understand because it kind of stems from a couple of days after Putin went into Ukraine, when the US Treasury froze Russian central bank assets. When they did that, it basically forced every central bank in the world that holds dollar reserves to have to come up with a plan B and have to think through the potential of what happens if the US decides that we are a bad actor. And today it's crossing a border. Tomorrow, who knows? Maybe we decide not to join a coalition against Russia or a coalition against China, and we get labeled a bad guy. Would they do the same to us? Probably not, but it's not a risk you can take on a national level. So the pressures are coming against the dollar. They're happening every day. We've just seen the French sign a deal to trade natural gas outside the US dollar. So it's not just kind of fringe countries now. And so it's happening. There's no dispute that this is happening. The argument actually comes with A, does it matter? And B, when will it actually make a meaningful difference? And that's obviously unknowable. But the people that say it doesn't matter and it will never matter frustrate me enormously. And the people who say the dollar's dying and it's going to happen tomorrow frustrate me an equal amount. Somewhere in the middle, there is a process underway that is heading in a direction that's plain to see. And that direction ultimately is going to put an undue amount of strain on the dollar. And so one has to understand what's happening and pay attention and try and identify the points where that pressure on the dollar starts to increase, because that's when things get interesting.
One of the reasons the US dollar dominance exists is because it's one of the deepest and most liquid markets in the world, but it's also backed by the stable rule of law. Now, arguably, as a lot of the other countries that are looking to do deals or shift away from the US dollar, they don't have any of these three advantages to even underpin the stability of their currency. Look, this is wild speculation, I guess, that I'm throwing out there, but how do they create a viable currency system without having these three kings that have actually allowed the US dollar to achieve this dominance?
Well, it's a great question, Shay, and it's absolutely one of the right questions to ask. But if you think about the rule of law underpinning the US dollar, and then think about what they did with the Russian central bank assets, right? That's why that was such a crucial move, because that basically was done without any reference to law. And as we've seen through the bailouts over the last 15 years, since 2008, laws in a crisis seem to get, certainly in the financial industry, seem to get run over roughshod. And if you can confiscate $600 million of a foreign country's financial assets with the stroke of a pen, I would argue that the rule of law is sacrosanct. And whether it's Russia crossing the border, if you have true rule of law, you wouldn't be able to do that just because they've done something that you decide is gives you the reason to do that. So that's the first point I would make, is that the rule of law in the West is not what it is, what it was. The rule of law is being changed. Contracts are being ripped up. There are all kinds of examples of that. The other side of that, obviously, is these other countries have to show a vast leap forward in those areas. And again, this is one of the areas where everybody is 100% dogmatic about this. China will never have a rule of law, and the West will never, ever let go of the rule of law. And, again, everybody needs to be a little bit more grey instead of being so black and white, and understand that, look what the French have done, right? The French have shoved through pension reform and upped the age of pensions, and have basically reneged on a promise they made to a whole bunch of people. They shoved that through without a vote. Macron put this through, and France is basically burning to the ground right now. People are so upset about it. The reality is this was something he had to do, because it's unworkable to have a country where 54% of the population work for the government, retiring everybody on full pensions at 62. It just doesn't work. And so if you look at what's happened in France, that is a signpost as to what happens in other countries when promises are reneged upon, which is another, a big part of what you need in terms of stability. The other big question that gets thrown about is the capital account in Russia, the closed capital account. And everybody says, well, there's no way they'll do that, because it just doesn't work for the Russians. They'll have too much capital flowing out of the country, and it'll cause problems for the yuan. All of which is true. However, that's not to say that changes won't happen. I agree how difficult it will be for those changes to take place. I agree with how unlikely they are to happen. But in this age of social media, there are so many people talking about using the word never. This will never happen. They will never do this. This will never change. The dollar will always be the reserve currency. And that to me springs from social media. Everyone takes a position, and instead of allowing themselves to be convinced that maybe they could be wrong, or maybe there is a slightly different potential outcome, everyone digs their heels in, because having made a statement publicly, they want to defend it and not be shown up in front of hundreds of thousands of people. So this dogmatism is one of the biggest enemies facing investors right now. You have to look at what's happening, and every day one of these bilateral deals is being signed to trade energy in a different currency, or to open yuan swap lines, or reroute gas and energy flows to countries who are friendly with a certain regime. It's happening every day. You cannot deny it. So to watch all that take place, all of which is a big change in the status quo, and say, but it won't change the status quo, I just think is dangerous thinking. It doesn't mean bet the farm on the dollar going away. It doesn't mean bet the farm on the yuan being the reserve currency. But it means you shouldn't bet the farm on the status quo staying the same. And that is a big step for investors to take. And it means a lot of thinking, and it means potentially some big adjustments to your portfolio.
Grant, excellent answer there. And there's actually two follow-up questions I've got that are going to stem just from that one answer of yours. First of all, you make an excellent point. It's never say never. These aren't laws of physics that we're talking about. These are man-made laws that we've created along the way to suit the market so we can understand it. They can change on a whim. Now that leads me to my next point that you so beautifully touched on, is the recent bank failures that have happened in the US, where it looks like equity holders were preferenced over bond holders. Now, arguably, this is changing some of those laws on a whim. Now, tell me, how is the implosion of those three banks in the US in 1 week, the Silicon Valley Signature Bank and Silvergate Bank, with, I think, First Republic wobbled a little bit after. How has that shaken the market's faith in the supposed rules of the financial markets that we're meant to follow?
Well, we don't know yet, and that's the interesting part. What we know is Silicon Valley Bank went to the wall. What we know is Silvergate went to the wall. What we know is Signature Bank went to the wall and was taken over by the FDIC. What we know is First Republic wobbled. What we also know is the response by regulators was equal parts sensible and foolhardy, in my view. And I wrote a long piece about this at the beginning of this month. The backstopping of depositors, I think, will turn out to be another potentially catastrophic knee-jerk reaction to a problem. because whether she likes it or not, and Janet Yellen was questioned on the Senate Banking Committee by Senator James Lankford of Oklahoma shortly after this, whether she likes it or not, whether she realizes it or not, and it seemed amazingly that she didn't quite realize this, but she's just backstopped $17 trillion of deposits in the United States, because to decide one bank is systemic and let another bank fail in these highly polarized political times is pure folly on the part of Janet Yellen. And so when he questioned her about, my constituents in Oklahoma, they're small banks run by farmers. Are you telling me if those go down, they're not backstopped? She said, well, no, we decide who is systemic or not. But if you take a look at the loan books and the asset books of the various banks, and look at banks with assets below $250 billion, which is basically the kind of signature mid-sized banks of the world, they account for just about 50% of real estate lending and consumer loans and commercial real estate lending. So you just can't make the argument that they're not systemic, because if there's a run on one of those banks and they don't get backstopped, as we saw with Silicon Valley Bank, all that money flows into JP Morgan, Bank of America, Citigroup, Wells Fargo. We all know the names. And that will happen again. So, unless you backstop the failing bank, you're going to see that run, and it will have exactly the same consequences, only much graver this time because of the recent memory bias people have. They will act much quicker this time if they see a mid-sized bank going under. And thanks to mobile banking, the run on the bank can be absolutely extraordinary. Back in the day, if they wanted to slow the bank run down, they would close all but one teller window. It was as simple as that, right? You pull the blinds down on 9 out of the 10 tellers, and you slow the run down by 90%. It really was that simple. You don't have that luxury anymore because everyone's on their phone, sitting in the bathtub going, oh, damn, I need to move my money. So the rule of law, is one thing. The laws of finance, and I'll put laws in quotation marks, are another. But there's a degree of uncertainty as to what the actual rules are anymore, because there's been so many bailouts and so much moral hazard. This time around, they were very clear, very early in the Silicon Valley piece, that they were going to stick it to shareholders, which is the right thing to do. That should have happened in 08. They've learned their lesson from 08, and we're explicit that we are going to zero out the shareholders. So we've kind of moved one step back towards the laws that people understand, that when there's a bankruptcy, the shareholders get wiped out. But are they going to wipe out the bondholders? No, they're not. Are they going to protect depositors? Yes, they are. So we've got another kind of fuzzing of the lines between what we understand the rules to be and what they actually are. And it's moral hazard writ large. So we're going to lurch from crisis to crisis, or potential crisis to potential crisis, and the responses are going to be similar in nature, i.e., we will throw as much money as this that we need to, and at the same time we will try and send a tough message so that it doesn't happen again. But realistically, until the pain is felt, real pain is felt, i.e. they let a bank go under and the FDIC says, if you had more than $250,000 in the account, I'm really sorry, but that's the extent of your insurance. Or, as they have in Europe, deposit holders get bailed in to bail the bank out, and they all get a haircut on their deposits. Until that happens, you're reinforcing the notion amongst investors and depositors that it won't happen. When push comes to shove, we'll get bailed out. And so, somewhere down the track, there's a nasty awakening coming for somebody. And one would imagine it's going to be at some point some kind of bondholder / depositor. And we saw this in the Credit Suisse when the AT1s got zeroed out as well. That's where this shock is going to have to happen, because otherwise the Fed's balance sheet is going to be, as my friend Felix Zulaf said at the start of the year, $50 trillion when they take everything and all this stuff on their books. And that will take care of any questions we have about the viability of the dollar, because it will trash it. So it's a very complicated time right now, because there are really big tectonic plates shifting in finance, and it's not a case of is Apple going to go up because their factories reopened in China? These are massively macro, big picture shifts happening that are very difficult for people to get their heads around, because they are not a number on a screen or a 3-letter ticker or something. These are geopolitical / high-level regulatory tectonic plate shifting, and the effects of them might not be felt immediately, but like aftershocks of an earthquake, they can kind of come rippling back through the economy, through the financial system for months after. So we really don't know what the events of the last couple of weeks are going to ultimately lead to, but it's going to lead to more instability. And that's something that every investor should be aware of and have a plan to deal with.
I might regret the next order that I ask my next two questions in. But I do want to just quickly shift to the Fed because I do want to touch on the actual investable outcomes here because it is an unusual time. But I do want to touch on what the Fed did because the Fed raised rates in spite of what was a banking crisis unraveling while it was backstopping these banks essentially. Now, that's very unusual central bank behavior. In years gone by, it's been let's cut rates and provide support. Now, but the Fed's gone and increased rates by 25 basis points. Now, initially leading up to the March FOMC, the chatter was around rates increasing 50 basis points. That didn't happen. Is this a case of the Fed couldn't look spooked? Or is this a case of the Fed is really on their inflation mandate and that's what they're going to stay on course with?
No, look, I'll tell you what this is. This is actually very simple. What this, they are desperate to use the same policies they've used for. I mean, some people will take it all the way back to 87. Some people will take it back to 2000. Some back to 2008. It doesn't matter. But for the longest time, their arsenal has consisted of rate cuts, rate cuts, rate cuts, and then when things get really bad, QE. The one thing that's been absent through that whole period is inflation, and inflation. On the other side of that is what keeps central banks honest. It's what disables them from just cutting rates to the floor and being able to get away with it. And they realize that they've clawed, depending which central bank you look at, 3 to 5% back from the abyss. And so the last thing they're going to want to do is give those cuts back in short order. I don't think we're going back to. I don't care how bad the recession is. We're not going back to zero interest rates. I really don't think that is the case, and I think it would be really foolish to give all this back. I think you'll find if we do have a recession, they'll begrudgingly give 25 here and maybe 50 there, but I don't think they'll want to give 50 at any point. And they'll try and maybe give 2% back and hang on for dear life, and then just say to people, look, this is it. This is the floor now. There's going to be some pain, and we have to get through that, because to get back to zero and try and get off your knees again, I think will be the devil's own task. So I think what happened there is that, yes, they have to stay firm. They have to stay credible on fighting inflation because it's a clear and present danger. And the only way to do that was to go another 25 basis points. If they'd stood still, which was, again, a pretty likely outcome, or God forbid, cut straight away, that would have sent a terrible message, particularly if they cut, and potentially cause a lot more inflationary pressure. So the absence of that inflationary pressure has what's enabled them to do all the things they've done. Now it's there and it's real. It's hamstringing them, and they have to take that into consideration. And that's why I think they're going to be a lot more parsimonious with their rate cuts as we go through kind of the next phase of this rolling crisis.
Quick follow-up question here. Are you on the pivot bandwagon or the no pivot bandwagon? Because there are two very clear camps.
Yes, I am.
There'll be a pivot or no pivot?
Yes, I know. Yes, there will, and yes, there won't be. There won't be. There won't be until they pivot. And this is, again, this is the crucial point of this, right? Because everybody's fixing on one or the other. And look, I am in the camp that they will have to pivot, but it makes a massive difference if they pivot in a month or 8 months. It makes a huge difference to your portfolio and how you trade this and how you invest through this. So, positioning yourself for the pivot because you're absolutely convinced they pivot and being wrong for 8 months as things get away from you is really dangerous. Assuming they won't pivot and positioning for that and finding out that they pivot tomorrow is equally dangerous. So, this I think is the big danger. And again, it comes back to this dogmatism. The dollar's dead. The dollar will never be replaced. They will pivot. They're never going to pivot. All of these are true. It's just at different points in time. And what the damage that's been done, I think, to investors over the last 15 odd years, this buy the dip mentality is very real because markets have basically gone up. We haven't seen a sideways market. And, people with as much grey hair as me remember markets that went sideways for a decade plus, it can happen. And so people are positioning themselves as though nothing's really changed. The Fed will ride to the rescue. And when they ride to the rescue, they'll be successful. And when they're successful, that success will look exactly the same. Asset prices will go higher. Inflation will stay low. All the same things are going to happen that have happened every time. And I think that is an incredibly short-sighted and incredibly dangerous viewpoint to take. We are in uncharted waters, certainly for this generation of investors. Say the old scrubs like me have been through similar times before, and even then, this is so long ago that even I was young back when it happened. So my memory of it is a bit hazy, but I suspect I'll get reminded pretty quick. So, nailing yourself to they've always pivoted, so they're going to pivot camp is probably right, because they're going to be forced to pivot. But they're not going to do it like they did at the end of 2018, beginning of 2019, when they buckled immediately. The market fell in December. Remember, we had that kind of shock on Christmas Eve, and markets were falling out of bed, and they pivoted straight away. And that's what I think people expect to happen, and that is what I think is not going to happen. So you could be very wrong, and it could be very painful if you get the timing wrong.
Grant, you have unknowingly led me perfectly to my next question, and this is the investable outcome. But this isn't. But this isn't the investable outcome for people with grey hairs. I cover mine. I want to talk about this younger generation coming through, the Gen Zs, and maybe the younger millennials. And the reason why is we're looking at one of the most tech savvy generations coming through, starting to invest in certain wealthy countries. Some of them are outpriced of traditional ways to wealth, which is the property market. Now, you said earlier in today's conversation that we're looking at not so much the slow decline of the US dollar, but the questioning of its role of dominance in a global economy, and how there is a big shift happening. And we throw on to that a banking crisis that we don't really know what the outcome of that is yet. But yet we're looking at a tech savvy generation that's basically been trained by crypto to embrace volatility. Now, you could think by that hard wiring that, when that's their first what would you say, first experience with the markets, that they're more likely to wade into volatile markets. But this is a different market setup. As you said, there's no buy the dip mentality here. Ushering in those younger people who are obviously bringing in much smaller dollar values to the market, how do you start to set them up? How do you teach them to invest at what is a precarious time to start investing?
But the best advice I can give you is talk to your parents. If your parents have been invested in markets, talk to them. Ask them what happened in 2008. Ask them how the world changed for them in 2008. What happened after 2008 that they were doing before 2008 that didn't work anymore? What was it about 2008 that hurt them? Where did they find out that they'd gotten their positioning wrong? Where were they too far over their skis? I've said this to my kids, and I've said this to so many people over the years. There are things you can learn. Sorry, there are things you can be taught, but there are some things you just have to learn. And unfortunately, particularly given the markets we've had, where this rising tide has lifted all boats, the lesson of the market actually carrying you out in a box, unfortunately, is something most of us have to learn. Because if you have listened to, say, old scrubs like me warning you about what can go wrong over the last 10 years, you'd be scratching your head going, this guy's an absolute idiot. You don't know what he's talking about. The market doesn't go down. You can't lose 50% of him. I mean, it's just ridiculous. The Fed always comes in, the markets rally, just buy the dip. And every time you've done that and you've been ultimately proved right, it's just reinforced that belief. And so, the same way you can tell your kids not to touch the hot stove 100 times, but if they touch it once, they'll never do it again. That's unfortunately the way markets work. I can sit here and tell you, perfect example, a friend of mine had a young intern working for him who'd made a fortune in crypto when it was up at 64,000 or whatever it was right at the peak. And he said, I've made so much money. And he'd made millions, this guy. And my friend said to him, look, sell some of your Bitcoin and buy your house. Just pay your house off. So you've got no debt, you've got a mortgage, you've got a house. And that way, God forbid you're wrong. And God forbid Bitcoin struggles and goes down or whatever happens, and he'd got leverage and all this stuff, so it didn't have to go far for him to get wiped out. At least then, no matter what happens, you own your house free and clear. You'll always have a roof over your head, blah, blah, blah. And of course, the kid's view was, are you crazy? Why would I sell Bitcoin to buy a house when my Bitcoin is going to be worth $1 million each? I could buy 5 houses for 1 Bitcoin instead of buying my house now for 10 Bitcoin or whatever it is. And we know what happens next. And that lesson was learned an incredibly hard way, as was the lesson of all the people who, God bless them, had money in Luna and were just thinking, well, I can make a 20% return risk-free here and keep that money, and this is fantastic. We know how that story ended. And I'm willing to believe and bet that most of those people won't get sucked in again to something like that. But the people who haven't been through that pain will probably wait until they go through something similar before they learn. And that's, as I've said to my kids all the way through their lives, I wish I could spare you every kind of pain that you're going to go through, and I can warn you about certain decisions you're making, and I can tell you not to do this, not to do that. And I understand, and it doesn't frustrate me that you're going to ignore me and do that anyway. But just please promise me that you'll learn your lessons. Just if you only make every mistake once, you're ahead of everybody. And that is really the big lesson here, is you're going to make mistakes. Try and recognize that things are very different now. And so when dips happen, it's not the same, because that dip could turn into a cascade, and that dip may not go screaming back up above your entry price again, and averaging down is a bad idea all of a sudden. Just understand that things have changed. Try and talk to people who've been around and have experienced different market conditions for the last 10, 15 years, because they've been really the same conditions for the last, for most, or not most, but a significant portion of people's entire investing lifespans, we've had the same conditions. And do your best to listen and take in what they say and act on it without being acted upon by the markets. I mean, that's really the best advice I can give people, in the full knowledge that the vast majority of them will listen and won't actually do it until it happens to them. And that's a painful lesson. But when those lessons come, don't take any more pain than you have to. If things get really bad and you get shaken out of positions, it's okay. It's okay to cut a position and say, I was wrong. And that's absolutely fine. It doesn't matter, right? As long as you're not too wrong, and you're not wrong for too long, and it costs you, your entire portfolio value, it's okay. You can lick your wounds and come again with some knowledge that will stand you in really good stead the next time you see similar conditions.
One of the most powerful lessons I learned early on in my investing career was, if you're going to be wrong, it's better to be wrong quick.
Yeah,
and then learn your lessons from that.
Yeah, and again, I know this is one of the kind of amplifications of this social media related dogma, is that it's even harder now to be wrong and admit it, because generally people have been very public about their opinions. Oh, this is going to that price, and this is going here, and that's going there, and they're very public about it. And so instead of 5 of your mates down the pub, you're telling them, Bitcoin's going to 100,000, and then it goes from 64 to 13 or whatever it is, and you walk in the pub with your tail between your legs, and your mate says, "Oh, come on, mate, have a drink." You've now got 100,000 people chirping in your ear going, "Hey, weren't you the guy that said it was going to 100,000? We're at 13. What are you doing?" And that's a tough thing for a lot of people to deal with, right? So dogmatism and hubris and ego and narcissism and all these things that are really encouraged by the world we live in are the absolute nemesis of being a successful investor in the next 5 to 10 years. So somehow you've got to get those things in check.
I have 2 more questions for you to round out today's conversation, Grant. First of all, where does this leave gold? Now, anybody who's spent enough time with me knows that I'm quite passionate about the metals' role in their portfolio. But given the uncertainty in the backdrop, and this isn't, the last thing I'm looking for is a repeat of dogma. What I'm looking for is the genuine perspective. Is gold going to play a bigger role going forward, especially as countries are increasingly moving away from using the US dollar when it comes to international trade?
Yeah, look, Is it going to? I don't know. Do I think it's going to? Yes, but they're two very, very different things, right? That's my conclusion, is that I think gold will at some point, and I gave a presentation about this back in, 2018, I think, called Cry Wolf, where I talked about the fact that when the monetary system is reset, the natural thing to do for a period of time, who knows, it could be 6 months, it could be 6 years, I don't know, is to reintroduce gold as an anchor, as a neutral reserve asset in the central of whatever the next monetary system looks like. And I still believe that will happen. But I don't know when. And what tends to happen with gold, the thing that people get dogmatic about with gold is the price. Gold's going to 5,000, gold's going to 800 because it's a worthless yellow rock. And all the talk about the price of gold is just such a waste of energy, because gold's not there to own for the price to go up. If you want to own gold for the price to go up, look, there's a million and one things you can do to guess the price is going to go in one direction. If you're a trader, to speculate on the price of gold, you never actually need to own gold. You can just play the futures, play ETFs. There's a thousand ways to do it. But owning physical gold in a portfolio has a very different role than trying to enhance your profit, in my opinion. I mean, other people will have a completely different view. But for me, it's a reserve asset. It's how I want to keep a significant portion of my liquid net worth, because I know that it will maintain its purchasing power over a period of time. And people will go, well, it hasn't over the last 6 months, and I'm not holding it for a 6 month period. I've never in my life sold an ounce of physical gold. I've bought it over the years, and I continue to add it. And at some point, I won't sell it, but I'll exchange it for something I want to own more for the long term. Maybe it's property, maybe it's agricultural land. I don't know what it's going to be. Maybe it's a bond portfolio when rates have screamed higher and bonds are selling for pennies on the dollar for great companies. I don't know, but I don't think of it at that point in time. Whatever the price of gold is not going to matter to me. I'm not going to do that because gold is trading at $2,000 or $2,500 or $5,000. I'm going to look at what's on the other side of it. I'm going to look at how many ounces of gold I have to give up to buy a property or buy some land or buy a bond portfolio. And I'm going to give up those ounces of gold in exchange for those other assets. And I'm going to hold those assets for whatever investment time frame I feel is appropriate. It's that simple to me. And whether gold's at, gold could stay at 2,000, right? And people say, well, the price hasn't moved. But if harbourside property here in Sydney is halved against gold, I have to give up half as many ounces to buy that house. So it doesn't matter that the price of gold hasn't changed. It just doesn't matter. And people get so fixated on the price of gold because we've become so used to measuring everything by price rather than value. And I think that's a really important thing for people to understand, that price and value are two completely different things. Price is fairly arbitrary and it can change on a different basis. Value can be completely different from one person to the next. An ounce of gold to me may be way more valuable to a guy who believes in Bitcoin. I value gold tremendously as part of my portfolio. A guy who owns Bitcoin is like, I don't want to know, it's completely valueless to me. Also fine, right? I'm not in a competition with anyone to guess the price. I'm not in a competition to sell it when it gets to 5,000. Could it go there? Absolutely it could. Could it go to 800? It absolutely could. I doubt that. But if it did, and other assets have fallen 80%, guess what? Gold still increased its purchasing power. And we saw this post 08. Gold initially fell when post Lehman because it was liquid and people needed liquidity. But if you look at what happened to the gold price, even when it fell versus what happened to equities, the purchasing power of that gold, even though the price fell, doubled. So, there are so many different ways to look at gold, and it's very difficult for a lot of people to think about because they're used to analyzing balance sheets or companies or having a story about why this is going to be a great investment because the growth prospects are fantastic and the total addressable market, I can't wait till that phrase goes away, by the way, which should happen fairly soon, is infinite, and all these reasons. You can't really do that with gold. You can look at the stock to flow ratio. You can look at the holdings. You can look at, relative to other things, but the price is just really the last thing you should be looking at, in my view. And there will be plenty of people watching this that want to argue that all day long, and I absolutely understand why. I have no problem with that. But I think if you think about gold as a means to making a profit, you think about it very, very differently to how it's performed over 6,000 years.
Excellent answer there, Grant. Also, too, for everybody listening, I do just want to mention, I think Cry Wolf is available on your YouTube channel, and I highly recommend.
I don't have a YouTube channel because I'm far too old for that, and I don't have a TikTok channel. But if you go to my website, grant-williams.com, I think it's on the about page somewhere. If you scroll on there, it's on there along with all my other presentations. But yeah, Cry Wolf was talked about this specifically.
I have seen it, and without the risk of sounding like a fangirl, fantastic. Highly recommend everybody watches it.
Thank you.
All right, Grant, our conversation is about to draw to an end, and I'm super, super grateful for your time and all that rushing through traffic to come join me today. But what I want to know, to close out today's conversation, I do like to try and neatly round it up for beginner investors, because at the end of the day, everybody's got to start somewhere, and often people don't know where to start. Now, with your decades of experience, do I dare put a number to that?
Pushing 4 now, yeah.
What would be your first entry level? What's that one thing that people should know about if they want to start investing?
Very simple. History. That, to me, if you want to know how to invest, if you want to become over time a successful investor, and I use the word investor rather than trader or speculator because they're two very different skills. And the first thing is to understand what you want to be. If you want to be a trader and you get excited by the cut and thrust and the swings and the volatility, that's a very, very different skill. And you should again, read history, read books about people like Jesse Livermore, one of the greatest traders ever to live. But if you want to learn how to invest, read history, read financial history, read every piece of Benjamin Graham you can get, read Warren Buffett's Berkshire Hathaway letters, and learn how to invest, because it's a game of patience in a world that is increasingly impatient. And so before you start looking at companies and balance sheets and all that stuff, try and learn as much history as you can. Not just about the stock market, but about political history and geopolitical history, and everything that's happening today has happened before. It's all there in the history books. And when you read the history books and you see how things have materialized before and what happened afterwards, it doesn't give you the exact roadmap. As they say, history often repeats, but it never rhymes. Or the other way around. I forget what Santayana said now. Anyway, either way, one of the two. But it's all there. And if you want one book to start with, I would recommend The Lords of Finance by Liaquat Ahmed, which talks about the 4 big central bankers after the war. And there are so many parallels in that book to the problems facing central bankers today. And it was a very different time with gold standards and all kinds of things. But it's a tremendous book, and it's a really useful intro to the kind of conundrums of central bankers, the cause and effect of their decisions. And importantly, the humanity aspect of how they deal on a personal and a human level with the situations they're in, because ultimately, at the end of the day, they are all human, and they're subject to the same kind of foibles and pressures that we all are. So I think that if I'm going to point you in the direction of history, I would say that is a fantastic starting place.
Look, that is actually an excellent place to finish our conversation today as well. Grant, I want to say thank you very much for being here. I really appreciate your time today.
Shay, thank you for being so patient, and my sincere apologies for keeping you waiting for an hour on a Friday afternoon. That was very unchivalrous of me, and I apologize.
That's okay. I had good company. Thanks, Grant.
All right, take care. Bye-bye.
What you think? Perhaps my favorite part of today's conversation was where Grant pointed out that inflation has been a way of keeping central banks honest. Now, obviously, in a rising inflationary environment, it doesn't look like the Fed is going to pivot anytime soon. But as Grant says today, it's important to remember that, yeah, sure, they might not pivot right now and they might pivot in 8 months' time, but you can't invest based on one or the other happening. You need to remain nimble when it comes to investing. Also, too, I think it's really important that he pointed out that we're not going back to a zero interest rate environment, and that people have become too used to the idea that central banks are going to rush in and fix things, and then all you need to do as an investor is to buy the dip. Rather, I think one of the key points of Grant's conversation is that you can't just trade with momentum anymore. And arguably, that's what a lot of people have been able to do for a considerable period of time. He points out that if you would like to be a successful investor in the coming years, and I guess for the next couple of decades, it's about learning history and understanding how to invest rather than just simply jump on a trend. That is it. If you like today's video, drop a comment below and tell me your favorite part about what Grant said. Now, don't forget to hit like and subscribe, because I have an amazing network, and that's exactly what I'm trying to do here. Bring to you interesting minds to help you become a better investor. That's it. See you around the web.